In this chapter 2, we discuss how you should market the ELN to your customer and explain its various features, including the very important task of sensitizing her to its key risk factors and the likelihood of good and bad outcomes. A first step for marketing the ELN might be to provide your customer with illustrations, among other things, of the worst case scenario, the break-even scenario, the expected scenario, to be explained shortly, and possibly an illustration of an excellent scenario. Each of these scenarios is analyzed on the worksheet labeled ELN Scenarios. The worst case scenario occurs obviously when the option expires out of the money, i.e. if the spot price of Microsoft at maturity is at or below $60, as shown in cell C5. This example is easy and leaves the investor with her principal from the redemption of the bond at maturity, as well as the annual cash flows of $1 she has received from the bond's coupons. Note that her last cash flow in cell C10 includes both the principal and the final coupon, since those are paid on the same date. The investor's annualized return under this scenario, also known as her IRR, for internal rate of return, comes obviously to 1%. Not much more can be said about this example. The break-even scenario in column D occurs when the investor's return reaches 6.25%, the rate she could have earned by simply investing her entire $100 in a 3-year deposit issued by your bank. The only variable that affects the investor's return is the spot price of Microsoft at maturity, appearing in cell D5. The worksheet enables you to calculate this price by using GoalSeek in Excel to solve for the final stock price that brings the IRR in cell D12 to exactly 6.25%. Thus, Tools, GoalSeek, set cell D12 equal to the value 6.25% by changing cell D5, hit OK, revealing an answer for the final stock price of $76.75. Note that the break-even occurs when Microsoft shares rise by an aggregate of almost $27 over the 3-year tenor, given the starting price of $50, or approximately 54% cumulatively from the initial $50. This turns out to decompound approximately into a 15.5% annualized growth rate for the price of the stock. This may be the easiest way for the investor to visualize the ELN's potential to outperform a simple bank deposit, since it boils down to a single view regarding the probable price of Microsoft shares at maturity. Calculating the ELN's expected return involves some judgment on your part and is subject to assumptions, that you will need to disclose carefully. One approach might be to assume that Microsoft shares rise annually by an amount equal to their historical growth rate. Another would be to assume that they grow by an amount equal to the average historical growth rate of all stocks in the S&P 500, or the NASDAQ, or even of a subset of the S&P or NASDAQ consisting of large technology stocks. No one answer is the right one here, but certainly you should limit your illustrations to those that have some plausibility based on history, current market conditions, and similar considerations. Using, for example, a 10% annualized growth rate for the price, which is a reasonable proxy for large US stocks over the very long term, you would program inside cell E5 the formula equals 50 times 1 plus 10% raised to the power 3, which results in a final stock price of 66.55 and a corresponding IRR of 3.12% appearing in cell E12. This may seem disappointingly low, but you should remember that the decision to seek principal protection on behalf of the customer has caused you to allocate a large percentage of her initial investment towards the purchase of the bond, which gives her the downside protection, and therefore that she should not expect as much upside in a bullish scenario as she would have had if she had invested her money entirely in Microsoft shares. Finally, you might discuss with your customer a scenario that shows a very happy outcome for Microsoft shares at maturity. Say, a 100% increase in the share price from the initial $50 to $100. While perhaps remote, this scenario is not outside the range of returns achieved by the stock during its best years, and conceivably could be repeated in the future. For this, you simply input, as we have done, the number 100 for the final stock price in cell F5, and look to cell F12, which reveals an IRR of 12.77%. Another good idea might be to compare these various outcomes to the investor's return under other possible investment alternatives. Somewhat arbitrarily, we have chosen here to compare the returns under the ELN to those under Alternative 1, a pure investment in Microsoft shares; Alternative 2, an investment in a 3-year deposit issued by the bank, which we know yields 6.25% annually; and Alternative 3, an investment in which we combine a 1% 3-year bond issued by the bank and costing 86.03 to provide coupon and capital protection with the purchase of shares rather than call options of Microsoft with the remaining $13.97. Note that under this alternative, with Microsoft trading initially at $50, this limits the amount of shares that we can purchase with our $13.97 to only around 28% of one single share, and this will significantly reduce our investors' ability to participate in any future stock price upside. The graph on this page shows clearly that in a very bullish scenario for the stock, e.g. when the stock reaches $80 or $90 or $100 at maturity, the pure stock investment, alternative 1, shown here in red, performs the best, as you would expect. The pure stock investment obviously outperforms alternative 2, the simple bank deposit, which is shown here in green, since the deposit's return is not in any way linked to the price of Microsoft shares. Alternative 1 also outperforms alternative 3, shown here in blue, since the amount of exposure to the stock price under alternative 1 is far greater than alternative 3. 2 shares here versus only 0.28 shares under alternative 3. And finally, alternative 1 in red outperforms the ELN, shown here in brown, for 2 main reasons. First, the exposure to the stock price under alternative 1 is twice as large, 2 shares under alternative 1 versus only 1 call option under the ELN. And second, the call option embedded in the ELN has a strike price of 60 rather than 50, so that the first $10 of price appreciation do not benefit the ELN investor. In a bearish scenario for the stock, e.g., where the stock finishes at 40, let's say, the best performer is alternative 2, the simple bank deposit, which yields 6.25%, followed by alternative 3, which benefits from the coupon and principal guarantee, but also from the remaining value of Microsoft shares purchased, followed by the ELN in brown at 1%, which also has benefited from its guaranteed components, but has seen its call option expiring worthless. And finally, alternative 1, the pure investment in stock, this time performs the worst, since not a single penny of the investor's money is protected from the Microsoft price decline. Scenarios involving more moderate stock price movements, such as an increase to $65, for example, are harder to explain to your customer in very simple terms. All 4 alternatives under this scenario yield a small positive return, but each of these returns is achieved from quite different contributions. Under alternative 1, in red, the return comes entirely from the price appreciation of the shares. Under alternative 2, in green, it comes entirely from the 6.25% coupon of the deposit. Under alternative 3 in blue, it comes from a combination of the 1% coupon of the bond plus the $15 price appreciation of the shares purchased. While under the ELN, in brown, it comes from the 1% coupon of the bond again, plus the $5 gain at maturity under the option. Having discussed with your client these various scenarios, you might want next to increase her understanding of the price sensitivities of the ELN to various changes in market factors, such as, first, changes in the Microsoft spot price, second, changes in option volatilities, third, changes in interest rates, and lastly, how the simple passage of time in and of itself affects the value of the ELN. This is especially important to communicate to your customer, since she may have to report the investment at fair value under her accounting regime, or may need to liquidate the investment prior to maturity, and may have the mistaken understanding that her principal will be returned to her in full, even under an early withdrawal scenario. In each case, we will proceed to plot graphs that show the changing value of the ELN corresponding to changes in the selected market factor, while holding all other factors constant, in order to make our analysis easier to understand. The mathematically talented among our listeners will recognize that we are calculating, in essence, the partial derivative of the ELN's price, in each case with respect to one of the market factors. The graphs we are about to show appear on the worksheet labeled Greeks and are stacked vertically down the worksheet, so they do not all appear at the same time. In this worksheet, rows 7 to 23 show the value of the ELN as the price of the stock moves up and down, and should yield no surprises. Changes in the share price cause the value of the option to change in the same direction, but obviously not by the same amount. The ratio of these changes, as you may know already from other courses, is called delta, a number which varies for a call option between 0 and +1, depending on how far in or out of the money the option is. In general, the deeper in the money the option becomes, such as when the stock price is pretty high over here, the higher the delta, and therefore the closer the option comes to rising dollar for dollar, or 1 for 1, in parallel with the spot price of the stock. At the other extreme, when the stock price is low, and therefore the option is deep out of the money, the delta of the option heads towards 0, causing it to become far less sensitive to small changes in the share price. Since the bond itself is completely insensitive to changes in the spot price of Microsoft, the ELN value therefore moves exactly by the same amount as the option. The graph illustrating the effect on the ELN of changes in the spot price appears immediately underneath, starting around row 39, and confirms what we have just described. Going further down this worksheet, rows 76 to 84 show the value once again of the ELN as volatility moves up and down, and again should yield no surprises. Ownership of a call option makes our investor long vol or positive vega, which means that her option position rises in value as volatility rises, and of course vice versa. Once again, the bond value itself is insensitive to stock price volatility changes, so the ELN follows in price volatility as it moves up and down. The graph illustrating the effect on the ELN of changes in volatility appears immediately underneath, starting around row 110, and confirms what we have just described. Rows 140 to 150, or thereabouts, show the value of the ELN as interest rates, and specifically here the risk-free interest rate continuously compounded move up and down and require a little more discussion. An increase in interest rates causes the bond to lose value since its cash flows are being discounted at higher discount rates. But by the same token, an increase in interest rates causes the call option to gain value, which offsets the bond effect to some degree. In this instance, it is fairly clear just from looking at this table that the bond's reaction to interest rates significantly dominates that of the option, so that the offsetting effect reduces a little, but certainly does not reverse the ELN's tendency to lose value as rates increase, and vice versa when rates decrease. The graph illustrating the effect of changes in interest rates on the value of the ELN appears immediately underneath, starting, as you can see, around row 173, and confirms once again what we have just described. If you do not know why an increase in interest rates increases the value of the call option, you should think of the effect this has on the forward price of the shares. The simplified formula for an equity forward is given by forward equals spot times 1 plus R over 1 plus div, where R is the risk-free interest rate and div is the dividend yield of the relevant stock or index, which is of course 0 in this instance. This formula runs parallel to the one for calculating FX forwards from the spot FX and the interest rates for the term and base currency, with which you may be more familiar, and like the FX formula, can be proven via a no arbitrage type of argument. Therefore, the equity's forward price increases as rates increase, which of course brings the call closer to the money, and vice versa when rates decrease. Note that the reverse would be true if our investor owned a put option, since an increase in the forward price would push the put further away from the money. The final and perhaps most interesting section in this worksheet is the one starting around row 202, which plots the ELN's price changes simply over time. But please remember, especially here, that as before, we are assuming that all other market factors remain constant, an entirely unrealistic assumption, particularly in this instance. Once again, we see from this table that the effect on each of the two components of the ELN appear to offset. The passage of time, which we simulate here by moving up the worksheet as the time to maturity gets closer and closer to zero, certainly appears to diminish the options value, a fairly universal process known as time decay. But the passage of time increases the value of the bond due to the price accretion from 86.03 to par. This second phenomenon is often referred to as pulling to par. More interestingly, you can see that the two effects are quite comparable in magnitude, and in fact dominate one another at different times in the ELN's life. Thus, in the first few periods, the bond appears to be gaining value faster than the option is losing it, causing the ELN in this column G in aggregate to rise in value, reflecting the general principle that for most normal options, time decay is initially quite slow. A second phase appears to start around the 8th quarter, when the time decay of the option starts accelerating and begins to dominate the gains in the bond's price, causing the ELN's price as an aggregate package to begin to decline. Still, a third but very brief phase begins towards the very end of the ELN's life, when the option, which after all is still $10 out of the money, has lost much of its value and is worth only $1 or just over, while the bond has a slightly larger gain still to achieve as it pulls towards par. And therefore, the bond, once again, dominates the option ever so slightly, causing the ELN once again to rise in value. This discussion should help you now understand the rather peculiar shape of the graph that has appeared in front of you and that lies directly underneath the last table, starting around row 236. This brings us to the end of this chapter 2.